Hi, it's Larry Gaines from OptionsOnTheOpen.com. I've been getting a great amount of inquiries and interest from people wanting to learn how to trade option spreads. They all want to know things like, how do you select the best stocks for option spreads to trade? When is the best time to enter a spread? And then, how do you manage them? Well, this has been just great music to my ears. I've been a professional trader for over 25 years, and most of my trading has always involved spread tradings of one type or another. So it has been a relatively easy addition to options on the open. The trading model I developed for option day trading has had great success. When you have a really good model, they can usually be modified for trading different trading durations, and in this case I wanted longer term trades. This has been done, and we are having fantastic results with the long-term option trades. I'm very excited about this new trading model, and now as a special bonus, members of Options on the Open have complete access to my long duration option trades that can last from one day to weeks or even months. These trades are all done using option spreads. From call spreads to iron condors, I cover them all. So now, in addition to option day trading, I am teaching members how to select, execute, and manage these types of trades. This is now part of Options on the Open each and every trading day. All trades I select are posted in the members area of our website so that members can follow the trades and learn from me how to make the same types of trades. To further help members learn how to trade spreads, the online trading desk is now open all day during trading hours to allow members to join in anytime during the day with their questions. We all have a limited amount of time, and it's all valuable. And not everyone can be on for the open or the close, so this is a unique service which allows members a more convenient access to me when they really need help on a trade. Just pop in and ring the trading room doorbell, and I'll make myself available to help you on your trades. Now let's look at an option trade that we did recently. I have always used macroeconomic fundamentals and technicals for all my longer term trading. I have great resources of fundamental information which I use to shape and formulate my macro trading views and formulate my plan. I then target these areas and keep a watch list of trading ideas with specific ETFs and stocks for potential trades based on my long-term view. Well, a big one just hit the radar screens, and this could be the trade of 2011 and beyond. It is a trade that is in its early stage of a potential long-term secular downtrend. It looks to me that we are in the beginning stage of a U.S. Treasury bond bear market. A big trigger was set off this past week with the compromise on an extension of the Bush tax cuts along with a 2% payroll tax cut by President Obama. The bearish factors for the bond funds are too many for this video, so I will highlight some of the eye poppers. According to Professor Jeremy Siegel, a well-respected authority of financial markets and global economics at the Wharton School of Business in Pennsylvania, the last time bond yields were this low was in 1956, and bonds suffered negative returns for 30 years. Man, that is painful. At the August top in U.S. bond prices, the U.S. Treasury market was effectively discounting 0% inflation for 10 years. Go figure, there's no way. Globally, energy, food, and raw material prices just keep trending higher. They aren't going lower. They aren't even staying anywhere close to fixed. The only thing hurting the U.S. growth is our high unemployment rate, but globally, commodity prices are going up, and that is inflation. Some very bearish U.S. bond news also came directly from an article written on October 27th by Bill Gross and PIMCO's Monthly Investment Outlook on their website. Bill Gross is the founder and COO of PIMCO, which is the largest bond fund in the world. In this investment newsletter, he said the amount of U.S. Treasuries purchased by the Federal Reserve will probably signify the end of the 30-year rally in bonds. He also said that check writing in trillions is not a bondholder's friend. It is in fact inflation, and truth be told, somewhat of a Ponzi scheme. It raises bond prices to create the illusion of high annual returns, but ultimately it reaches a dead end where prices can never go up. This leads me to the view that we want to be sellers of U.S. Treasury bonds on any major rallies. Now this is the trade we put on this past week. This is a chart of the TBT, the Ultra Short Lehman 20-year plus Treasury bond ETF. It is a double inverse ETF of Treasury bonds, so as bonds go lower, this ETF goes higher. It has great liquidity and is an excellent way to play the short side of the Treasury bond market. Using our trading model for timing entries on the 1st of December, right here, I put on a long-term option call spread out in January of 2012. I bought the January 2012 34.43 call spread for $3.50. Now remember, one option contract is equivalent of 100 shares of stock, so this basically for one contract costs $350. My maximum upside profit at expiration based on the spread is $750 per contract, and my maximum risk is $350 per contract. I'll probably be out of this trade long before expiration at the rate that bonds have been selling off, but this long-term option spread gives me plenty of time to wait it out. With the surprising news about the tax extension last week, I decided to add to my short position, and on this date, December the 8th, I bought the March 2011 41.49 call spread at $1.40 per contract, or $140 per contract. The maximum upside profit on at expiration on this trade would be $660 per contract, with my maximum risk at $140 per contract. This has a really very nice risk-reward ratio of over 4 to 1. The big difference between these two spreads is the time frame or duration. Plus, on this first trade put on here on December the 1st, this spread out in 2012 was a deep in the money call spread, where I bought the call at a much deeper in the money level. So I have to I make my gains a lot faster if the market goes up because I have a greater delta on the long call. But anyway, if you would like to learn more about trading like this, and would like to learn how to trade option spreads or day trade options, and just follow my trades and learn how to do this, please join us at optionsontheopen.com. That's optionsontheopen.com, and thank you for your time.